see, we have cases in many different legal areas, but the one that I deal with and that you're probably here for also is tax. So, as I said, when you join MVLS, you're getting access to lots of training materials, mentorship, um, plenty of volunteer resources. So, if you're willing, I know it's tax season right now, so people are busy, but if you're not a volunteer yet, please visit our website to learn more about what you can do to help. These cases, with our clients, especially in the Baltimore area, um, often the amounts in controversy, they seem like really simple cases to us, couple $1,000, denied credits, incorrect withholding, somebody didn't know they were an independent contractor. But they can be really life-changing for our clients. It can be the difference between them making rent and not. So without any further ado, I will hand it off to our presenter today, Miss Heather Posey, who is a very frequent and great volunteer with us.
Thank you so much, John. All right. So today I wanted to talk a bit about just certain strategies that I feel are either lesser known or they're just kind of like niche one-off things that aren't conducive to doing a full webinar on the entire topic, but just things that can kind of get thrown in just kind of as a potpourri of different things. This is my bio, which you can read that later. I want to jump right into what we are doing today. The first thing I want to talk about is the Taxpayer Advocate Service. I know that for some practitioners, this is a staple of their practice. They turn to TAS constantly. And then for others, they don't utilize TAS at all. They are still working just within the normal IRS procedures to try and resolve issues. So I want to shed some light on exactly what types of cases TAS can help with and how valuable of a resource they can be. I also want to talk about how you can protect certain refunds from being offset against either past due tax liabilities or other government debts in certain situations. I want to talk about Maryland's hardship programs that they offer to certain low-income individuals to help provide relief from collection efforts. I'll talk about some offering compromise strategies, the limited penalty relief available to some partnerships, and then payment extensions. So getting right into the Taxpayer Advocate Service, as I mentioned, it's something that a lot of practitioners use a lot. And then there's like this divide where there are some people who do not use it at all. So I just want to shed some light on the Taxpayer Advocate Service and what they could do. So they are, if you don't already know, they are an independent arm of the IRS. They report directly to Congress with what they feel are some of the biggest issues facing either the IRS or taxpayers. And they work within the IRS directly with certain IRS functions to resolve a taxpayer's issue when either the taxpayer's issue is an emergency, essentially, or the taxpayer is unable to get a resolution through the established means. So this office is headed by a national taxpayer advocate right now, that is Aaron Collins. And then there are local taxpayer advocate offices throughout the country. There's at least one in each state. Some states have multiple, so that there is someone local to the taxpayer that they can deal with. TAS is honestly invaluable when it comes to cases where you just cannot get traction. Normally, there are a lot of situations where you try to resolve things through the normal functions, and maybe the IRS sends you a response that is, just nonsensical. It just seems like they didn't even read what you sent at all, and they just send like a summary denial, or you just need someone to actually pay attention to what this issue is. And if someone did that, then it could be resolved. So when it comes to what types of cases TAS works, they have 9 established criteria for accepting cases, and these are reiterated in both the tax code and the regulations, and then also in IRM 13.1.7. That is everything that deals with TAS case criteria. So I want to discuss those next. TAS case criteria is kind of separated into 4 different buckets. The first bucket of those types of cases are economic burden cases. These are cases where the taxpayer is experiencing a financial difficulty, either an IRS action or their IRS's inaction has caused or will cause negative financial consequences to the taxpayer or have a long-term adverse impact on the taxpayer. So there's 4 within this bucket. The first one is economic harm, where the taxpayer is experiencing economic harm or is about to suffer economic harm. And this can be caused by either the IRS's actions or inaction, or it can be caused by situations arising in the taxpayer's personal life. But in any case, the taxpayer is experiencing or about to experience an economic harm, and IRS action could remedy that harm. So one example that the IRM uses is where a taxpayer's return is being audited, and this is in a prepayment audit. They're auditing for maybe earned income credit or another refundable credit, and the taxpayer is due a refund of $3,000, and they really need that money to pay for medical expenses, but they can't wait for the examination to finish and for that refund to be released. So TAS can step in and help release that refund so that the taxpayer can pay for those medical expenses and that economic harm can be alleviated. The second type of cases is where a taxpayer is facing an immediate threat of adverse action. Now, again, this can be either adverse action by the IRS or it can be adverse action in the taxpayer's personal life. This can be from, utility shut off. This can be from an eviction, a repossession of a vehicle, or it can be IRS collection actions like garnishments, levies, liens, etc. And those adverse actions obviously could have a long-term adverse impact on the taxpayer or just cause an immediate financial hardship. And in these cases, TAS can step in to, maybe release a refund that the taxpayer really needs to pay for their utilities or pay their rent and avoid eviction, or to just kind of stave off IRS collections while their case is being resolved. The third of these is situations where there's no immediate threat of economic harm, but the taxpayer is going to incur significant costs if this IRS issue cannot be resolved. And this includes fees for professional representation. So this is situations where the IRS's delays in making adjustments to their return, processing returns, releasing a lien would result in them having to incur significant costs, either, through professional fees or other costs, but you want TAS to step in and quickly make whatever adjustment needs to be made so that the taxpayer can avoid having to incur those costs. Then the fourth type is where taxpayers are going to suffer irreparable injury or long-term adverse impacts if relief is not granted. And this is going to be situations where a taxpayer is under threat of losing assets or income or potential income if relief cannot be granted. Maybe there was an erroneous lien filed or an erroneous lien threatened, and that would cause the taxpayer to lose their ability to be licensed or bonded in their profession. If there's a federal tax lien filed against them, then maybe they would be unable to get clients, especially if they're, a financial advisor or a realtor or something of that nature. So in these situations, TAS can step in and try to obviate that threat to make sure that the taxpayer is able to avoid losing their assets or their income. So the second bucket of these cases is going to be systemic burden cases. These are the types of cases where the taxpayer doesn't need assistance because of financial reasons, but it's more so the IRS is current systems or processes, procedures, etc., have failed to operate as they were intended. And this means that it's indicative of there's a systemic burden within the IRS that is making it difficult for the taxpayer to get the resolution that they need. The fifth criteria here, the first case in the systemic burden bucket, is where taxpayers have experienced a delay of more than 30 days to resolve their tax account issues. Now, a delay of 30 days is measured by the established time frame for the IRS to resolve a specific issue, depending on what department it's with. If this is an offer and compromise, this is going to be a very long window. 30 days to resolve an offer and compromise is just not working. But other areas where it's 30, you're looking for 30 days beyond what the expected or typical response time is for that certain action. Now, for things where there is no established time frame in providing resolution, when the problem or the inquiry is delayed more than 30 days after the taxpayer has initially requested assistance, then TAS can get involved. And this can also be met when the IRS is sending a lot of interim responses. They send those 30-day letters or 60-day letters. They say, oh, thank you for your inquiry. We try to resolve issues in a timely fashion, but unfortunately we need 30 days, 60 days, etc., to review your response. So if the IRS has sent a lot of those interim letters, but still nothing has happened, then the taxpayer advocate can get involved. Two more in the systemic burden bucket. There are cases where the taxpayer has not received a response or resolution to their problem or inquiry by the date that the IRS promised. Sometimes in those interim letters, they will say, okay, we will respond to you by such and such date, or you're in contact with a specific person at the IRS and they say, we will resolve this by this date. They essentially are giving themselves a deadline. If the taxpayer has not heard anything from the IRS by that date, they can also request TAS involvement. Now, this I think is very loose because the IRM states that the taxpayer can request assistance as soon as the next day, essentially. If the IRS gives a promised response date and they fail to meet that date, then the taxpayer can go straight to the taxpayer advocate service. And then lastly, the last criterion, systemic burden, is where a system or procedure has either failed to operate as intended, or it's just otherwise failed to resolve the taxpayer's problem or dispute within the IRS. This one is intentionally open-ended. It's kind of a catch-all where there are any situation that doesn't meet the other 6 criteria, it can normally be accepted within the 7th criteria. And even in the IRM, they state that if a taxpayer requests TAS assistance with their issue and no other criteria is met, that it should be accepted under that criteria because the fact that they are going to TAS indicates that they are either unwilling to work with the IRS or have not been able to resolve it with the IRS. And the mere fact that they're contacting TAS means that there's an issue with IRS processes and that something has failed systemically. Now, these last 2, these are, much less common. Best interest of the taxpayer cases are where there's really nothing else but TAS acceptance of that case would help ensure that the taxpayer receives fair and equitable treatment and that their rights as taxpayers are being protected. And then last, we have public policy cases. These are cases that are determined by the National Taxpayer Advocate. The National Taxpayer Advocate normally sees certain systemic issues or sees a prevailing issue and writes a memorandum stating that these types of cases where taxpayers are experiencing this specific issue can be accepted under the TAS criteria 9 public policy. As an example, the National Taxpayer Advocate previously determined that inquiries related to automatic revocation of a nonprofit's tax exempt status, like where they automatically revoked it when they didn't file returns for 3 years, those could be accepted under the public policy criteria. So requesting taxpayer assistance is done via Form 911. The form itself is pretty short, of course, their name, their address, taxpayer ID number, whatever tax period and tax form are at issue. And then they give you a little bit of space to describe the issue that's being experienced. What I normally do, and of course what everyone in my firm does, is we don't try to shove the issue into that small box. We write a separate narrative that is at least 1 to 2 pages, where we describe exactly what the taxpayer's issue is. We describe what steps they've taken thus far to try and resolve the issue. We will include copies of any correspondence that the taxpayer receives, any correspondence that the taxpayer has sent to the IRS to try and resolve this issue. We try to show the back and forth to demonstrate that these IRS procedures are not working. There is a burden here, and we really need TAS to step in. Or if we're trying to get TAS assistance because of economic burden, then we will kind of give a narrative of what the taxpayer's financial circumstances are and try to provide some type of substantiation that shows that, like maybe eviction notices or utility cutoffs or other bills from creditors or businesses showing that the taxpayer is in dire financial straits and really needs taxpayer advocate assistance quickly. What I will normally do is I try to cite the specific case criteria that I believe could be used to get that case to be accepted. Because while there is case criteria 7 with systemic burden, like just the fact that someone requested tax assistance is indicative of a systemic burden, sometimes they don't take cases. They just like every other IRS agency or sub-agency have very limited resources and are short-staffed and are overworked. And sometimes they cannot help everyone. So I want to make 100% sure that my clients are being helped. So I try to cite exactly what case criteria my client satisfies to say this case should be accepted under case criteria, XYZ. Another part of TAS that I think can be very helpful, at least in the bigger picture, is systemic advocacy management system. This is something that TAS has separately, where when you as a taxpayer, you as a representative to taxpayers, or even an IRS employee, see maybe a pattern of issues, or you see a singular issue that you believe could affect multiple people and be a systemic issue within the IRS, you can submit what's called a SAMS request. You go on the TAS website, you describe what the issue is and how it is indicative of a systemic failure. And then that request gets assigned what's called a SAMS ID. And then other taxpayers, tax practitioners, etc., can then submit SAMS requests with that same ID to try and bubble it up to the top to kind of create a bigger picture of like, hey, many people are experiencing this issue. This is likely a systemic issue. And I think TAS needs to step in and advocate either advocate before Congress, either try to work with the IRS to resolve this, or just start accepting these types of cases as public policy cases. This is a situation where the taxpayer advocate will write a memo and say these types of cases are indicative of a systemic issue, and we need to start accepting them for public policy reasons. Another invaluable, I think, way that the taxpayer advocate service can help taxpayers is by helping some taxpayers get what's called an offset bypass refund. So there are situations where a taxpayer may have past due tax liabilities, and as a result of that, their refund would be offset. They would not get any of it, or they would get much less of it. Now, in the tax code, it specifies that the IRS may offset refunds for prior year tax liabilities, and the IRS must offset refunds for other government liabilities, like anything else within the Treasury offset program. So this gives the IRS discretion in these situations to bypass the not required, but the offset process and issue a refund when a taxpayer desperately needs it. These are going to be taxpayers who are experiencing a financial hardship, and them receiving the amount of that refund would alleviate that hardship. So in order to get that, you have to coordinate with TAS first before the return is filed. Because once the refund is taken as an offset, it's gone. You can't get it back. So you need to coordinate with TAS first, explain that the taxpayer is experiencing a financial hardship. You need to prove what the hardship is and the amount of the hardship, because the IRS will only allow you to bypass the offset for the amount of the hardship. So if someone is anticipating a $3,000 refund, but they just have an eviction notice and they need to pay $1,200 in rent in order to avoid being evicted, the IRS will allow for a refund of $1,200, but the remainder of that would still be subject to offset. So what happens is you work with TAS, they put an indicator on the taxpayer's account that ensures that the offset process does not happen, or it happens in a limited scope. And then after that indicator is on the taxpayer's account, then the taxpayer can file the return, and then that refund will be issued. It's going to be a manually issued refund, so it might be a little bit slower, but it will still be issued. Now, this type of refund offset bypass is only available if the taxpayer's refund is going to be offset to pay past due tax liabilities. Like I mentioned, the tax code states that the IRS may offset refunds to pay past due tax liabilities, but that the IRS must intercept tax refunds to pay for other Treasury liabilities, or just anything certified with the Treasury offset program. So this could be child support, this could be state debts, this could be unemployment debt, this could be student loans, anything other than past due tax liabilities is not going to be protected under the offset bypass refund program. It can only be when it's applied to past due tax liabilities. So this is a very limited scope technique that can be used, but I think that when it's appropriate to be used, it can be incredibly helpful to these taxpayers who are the most vulnerable and who need it the most. So kind of keeping in line with protecting refunds from offset, I want to talk about injured spouse allocations. Now, for the tax preparers on the call, I'm sure that they are very well versed in injured spouse allocations because it's something that you do a lot. But for maybe the lawyers on here who don't do so much return filings, injured spouse is a little bit of an afterthought because they are normally focused on injured spouse, which is, or I'm sorry, innocent spouse, which is specifically a controversy matter. An injured spouse goes along with the return filing. It's more of a tax planning matter, usually. So just to clarify, a request for innocent spouse relief requests the IRS to relieve one spouse of all of past due tax liability or a portion of past due tax liability that arose from prior jointly filed tax returns. A request for an injured spouse allocation is a request that is made with a jointly filed tax return when it's being filed in situations where that joint refund would be intercepted either in whole or in part, and that interception would be used to pay the debt of only one of those spouses for which the other spouse is completely not liable. If the interception would be going towards joint tax liabilities from a prior year, an injured spouse allocation is not going to work. This needs to be one spouse has prior tax debt from when they filed separately or before they were married. They need to have like other federal debt, like child support, unemployment, state debts, etc. Just any reason why the refund would be intercepted. But if that interception is only a result of one spouse and the other spouse is completely not liable, then you file Form 8379 with the tax return. And then from there, the IRS allocates the refund because not all of the refund is going to be due to the injured spouse. Some of it can be allocated to the non-injured spouse as well. So the IRS kind of divides it based on which spouse is eligible to claim exemptions, which spouse is eligible to take itemized deductions, which spouse had withholding and how much withholding and how much was their income, et cetera, et cetera. So injured spouse allocations do not apply if there is a balance due on the return. They can't work like an innocent spouse relief request to kind of allocate the joint liability to either spouse. It's just a way to protect joint refunds from being fully offset. And I want to note that many states have their own state-specific injured spouse form. You can't just file the federal injured spouse form and have it carry down to the state returns. You need to file a state-specific injured spouse form to protect that state refund from similar offsets. And then another thing that I want to note is there are, of course, situations where the taxpayers don't know that their joint refund is going to be offset for one person's debt, and then it gets offset. And the 8379 in those situations can be filed separately to request that the IRS allocate the refund retroactively and pay out a portion of the refund. I mean, this process takes significant time, many, many months, but it does happen. So it is something that can be done after the intercept, unlike the offset bypass refund, which has to be done first. All right, so moving right along, I want to jump into the state of Maryland has some hardship programs for certain low-income taxpayers that essentially just help relieve them of collection enforcement actions being taken by the state of Maryland. It's essentially the equivalent of the federal's currently not collectible status. So the benefits of these are that there's no payment required to be made by the taxpayer. There's no payment plan required to be made by the taxpayer in order to stop enforcement action. Any current professional or driver's license holds, like any MVA holds and professional license holds, are released. There are restrictions on future license holds. Of course, the case is not referred to a private collection agency. There is little to no documentation required. Sometimes you have to submit a financial statement, but that's it. It's not hugely burdensome. And these requests are typically approved within a few days. It's very quick, and the MVA holds will likewise be released very quickly. It can take just a matter of days from requesting relief to the taxpayer being able to renew their license or renew their registration. And for these, you can request relief via email. And that's what I typically do. I just send an email to lowincome program@marylandtaxes.gov, and I will list the taxpayer. Sometimes I attach my power of attorney if it's not on file yet. I'll explain their circumstances. If it's required, I will submit a financial statement as well, but not all the time. All right, so there are 3 different types of these cases. So the first type is what Maryland calls traditionally a hardship case. And these cases, the taxpayer's household income must be 200% or below of the federal poverty level, and their only source of income is Social Security or a pension. So these are typically older taxpayers with on a very fixed income that simply cannot afford to pay their Maryland tax debt. In these situations, the state of Maryland will no longer offset their federal tax refunds, and they will not offset any vendor payments. Now, they will still offset Maryland tax refunds. They can still file a Maryland state tax lien, and the taxpayer is required to be in filing compliance. The next type of case is called low income relief cases. Now, these, again, the taxpayer's income has to be 200% or below of the federal poverty level, but the income can be from any source. It doesn't have to be specifically from Social Security or a pension. They can be any age. It's just an income-based relief program. And in these cases, the taxpayer's liability is placed in a temporary hold status. Now, with hardship cases, it is pretty permanent because they're on a fixed income, which is likely not going to change. But with low income relief, they could be any age. Their income can vary year by year. So it's just a temporary hold. So in these situations, Maryland and federal refunds continue to be offset. Vendor payments continue to be offset. The state may file a Maryland state tax lien. They may require that the taxpayer increase their withholding. Of course, it depends on where they are getting their money from. And the hold on the taxpayer's account is reviewed annually. They look at their income to see if it's fluctuated enough that they are no longer at 200% or below of the federal poverty level. And then at that point, they will take it out of the temporary hold and they will resume collection actions. And again, the taxpayer is required to be in filing compliance. The third type of case is cases where they call expenses in excess of the amount of their income. And because of that, they are unable to make payments on their tax liability, and otherwise paying on their tax liability would create an undue hardship. So again, the case is placed in a temporary hold status. The Maryland and federal refunds continue to be offset, vendor payments offset, the lien is filed. If necessary, withholdings will be increased depending on where they get their income. They have to submit annual financial statements. So when you are requesting this type of hardship relief, you are sending in a Maryland 433 showing their assets, their liabilities, their income and expenses. And then you need to do that again annually. If at any point their financial statements show that either their income has increased, their expenses have decreased, and they have an ability to start making payments, then the state will remove them from this collection hold and refer their case for collection action. And as always, the taxpayer must be in filing compliance. All right. So outside of Maryland relief, I want to talk a bit about federal collection relief, i.e. the Offering Compromise program. So there are some strategies that can be very beneficial. Sorry, I'm trying to adjust my laptop. There are some strategies that can be beneficial to kind of help put your client in a better position to achieve, hopefully, a better result when it comes to getting an offer in compromise. So when you are doing a taxpayer's financial statements and the financials show that the taxpayer does have an ability to pay, they have an ability to pay something, they have like equity in assets that the IRS would try to take, but the taxpayer can't afford that. This is going to be cases where maybe they're unable to access the equity in their home because of their poor credit, or they are a little bit older and they have money in their retirement account, but obviously they need that money for when they stop working, or they're disabled and they need what money they have to provide for the rest of their life. In these situations, you could submit the offer in compromise as doubtless to collectability special circumstances or under effective tax administration. So in these situations, you are essentially trying to convince the IRS that while the taxpayer does have equity in assets, it would be either inequitable or to take them from the taxpayer, or it would cause an undue hardship if the IRS were to take that equity from the taxpayer. So this normally requires a pretty lengthy narrative that explains the taxpayer's special circumstances and why it is not in the IRS's best interest to take that equity because of what it would do to the taxpayer. For older taxpayers or people with disabilities that have equity in assets, what I normally do is I try to incorporate an actuarial table that shows, based on the IRS's actuarial table, what their life expectancy is going to be, like how many more years they need to be able to access that equity and be able to use it to pay for their necessary living expenses, or if they have pretty large medical expenses, why they're going to need to use that money, and over how many years they're going to need to use that money. And that can kind of show to the IRS that they have this money, but they really, really need it for the rest of their life. And if you take it from them, it's going to create a severe hardship for them. They're not going to be able to pay their basic living expenses, or they're not going to be able to pay for the medical care that they need based on their disability. It's a long process, and I think our firm has found that in some of those cases, the offers will be rejected on a lower level, and it has to be resolved in appeals. So it's not something that I would take lightly. It's something that I would try to spend a lot of time putting together. But in the end, it can be incredibly beneficial for these types of taxpayers. So another offer and compromise tip that I want to talk about is dissipated assets. So something that the IRS does is they will normally look at the last 3 years of the taxpayers, if they took any withdrawals from retirement accounts, if they sold property, etc., and the tax liability that you are trying to compromise existed at that time. And the taxpayer took that money, but they did not pay the IRS with it. They used it for other things. Then, in some situations, the IRS will consider those a dissipated asset, and they will add it to the taxpayer's equity in assets computation. Basically, under the reasoning that they could have and should have used that money to pay the IRS, but they did not. So that should be considered equity that they can therefore pay over to the IRS. Even though they don't have it, the IRS will still consider it equity that should be paid over to the IRS. Now, if you can prove where the money went, like that it went to purchasing their home, or that it went to paying necessary living expenses, then you can avoid having it being treated as a dissipated asset. But what I like to do is I like to look at the last 3 years of the taxpayer's wage and income transcripts at the least to look for any withdrawals, property sales, etc., so that I can get ahead of the offer examiner by knowing that that may become an issue. Then I can work with the client to collect documentation so that we can possibly avoid having these things we consider dissipated assets. And another tip with offers and compromises, of course, you can choose the 24-month option or the 6-month option. And with the 6-month option, you are required to make a 20% lump sum down payment that if the offer is rejected, you just lose it. So something that you can do is you can submit a 24-month offer and compromise to try and avoid risking that 20% lump sum payment. And then when the offer, or if the offer is accepted, then you can request that it be changed to a shorter offer and compromise payment term, just as a way to kind of get around that risking that 20% lump sum payment. Now, of course, them accepting your proposal is discretionary, but it is something that can be done, especially in situations where maybe you don't think, maybe there's not a fantastic chance of the offer getting accepted, or it's not like a shoe-in, definitely they're going to accept this. All right. Another strategy for determining equity and assets in the IRM 5.8.5.7, there is a $1,000 reduction in the taxpayer's equity in bank accounts. This is just kind of a flat across the board, something that they give. You, of course, compute the ending balance of their bank accounts, and then you subtract 1,000, and that is their equity in that asset in offers. However, that same IRM section has an additional example where you can further subtract 1 month of the taxpayer's living expenses. So in that situation, what I do is I'll do the 433, and then whatever that 1 month living expense figure is, then I will subtract that as well from the taxpayer's bank account balance. Now, the example in the IRM, it states kind of like specific scenarios where this can be considered, such as where a taxpayer's checking account balances fluctuate greatly from month to month, such that the offer examiner would have reason to believe that an amount in excess of that $1,000 is needed to pay for monthly allowable expenses. This is especially true for taxpayers who get paid kind of periodically. They aren't on a salary, or they're not getting paid every 2 weeks. It's just kind of when they get money, especially if they are a small business. So in those situations where the balance is just fluctuating constantly, you have reasonable grounds to subtract 1 month of the taxpayer's living expenses from the equity in their bank account, in addition to that $1,000 reduction. So this is something that I do most of the time. Honestly, I do it most of the time, because even if they say no, like even if they feel that that taxpayer doesn't qualify for that additional 1 month of living expense, then we're back in the same place where we would have been if I hadn't included it. So it's something that I try to include in more offers than I don't include it. All right, so another special consideration for offering compromises is recently there have been a lot of complex scams going around, like very complicated scams, impersonation scams, romance scams, ransomware attacks, and specifically investment and cryptocurrency scams, where they are, they're typically called pig butchering scams sometimes, where they are taking significant amounts of a taxpayer's money. And sometimes taxpayers have liquidated their retirement accounts in order to, in furtherance of this scam, or they've otherwise incurred significant tax liabilities from maybe selling property or things of that nature. Essentially, they have a huge tax liability because they were scammed, and now that money is gone and they have no way to pay the tax. So sometimes in these situations, the traditional offer and compromise strategies may not be successful, or at least get the taxpayer the best results. So in the IRM, there is discussion of offers and compromise that are submitted under effective tax administration, where taxpayers can request relief under effective tax administration because the criminal or fraudulent act of a third party is directly responsible for the tax liability. And upon plain reading, that makes sense that these cases where taxpayers liquidated their retirement accounts in order to give money to the scammers who told them that, hey, we're going to be investing it, or hey, let's do this cryptocurrency, investment program. You're going to make a lot of money, et cetera, or they took it out because of a romance scam or other type of scam. But in these situations, at least our firm has repeatedly found offer examiners and appeals having considered these actions to be a result of the taxpayer. Like these are the taxpayer's own actions, despite the taxpayers doing so under the guise of, criminal or fraudulent activity that was being perpetrated against them. The offer examiners are saying, no, this was the taxpayer themselves that caused the tax liability. They took the money out of the retirement account themselves. They gave it over to the scammers themselves. So they are not accepting offers and compromises for these scam victims that are proposed under effective tax administration. And that creates a huge issue because the money's gone. They have no way to pay the tax, although they may have some equity in assets, but it still seems, essentially inequitable that they were the victim of a crime and now they are being denied any kind of relief on the tax liability that arose from that. So one possible avenue of recourse would be doubt as to liability offers that are based on Section 165C2. So for some clients who have fallen victim to investment scams and cryptocurrency scams, doing an offer under doubt as to liability or just amending the tax return might be a better option if that scam can qualify as a theft loss. So although the deduction for personal casualty and theft losses is gone under TCJA, theft losses that are either incurred in a trade or business or those that are not connected to a trade or business, but were otherwise incurred in a transaction entered into for profit remain deductible normally as an ordinary loss. So some types of scams can qualify for this 165C2 treatment. And this is namely investment scams. This is going to be cryptocurrency scams, Forex scams. These are situations where the scammer approaches the victim and states that they have this investment opportunity, that they are doing so well investing in cryptocurrency or investing in stocks, etc. And they induce the taxpayer to participate by sending them money. And of course, they keep the money. And it does require pretty detailed analysis. You're going to be looking at what did the scammer say to your client? Did they promise investment profits? Did the client send money to the scammer or the investment platform for that purpose? Were the scammer's actions in trying to induce your client to send them money considered a theft under state law? Because that is the controlling factor for what is considered a theft loss under federal law. What we here normally do is we try to review the client's conversations with the scammer and try to parse out whether there was a profit motive or whether it was connected to a business. We will also look at any police reports that the client filed contemporaneously, because those also will show some information on why they gave the money over to the client. So again, this is pretty detailed. We have been doing a lot of these lately, or at least assisting clients determine whether or not their theft loss is deductible, because it is so prevalent right now. I mean, it's insane how many people are being victimized and how much they're losing. So I think that for scam victims, this is a very, very viable option. I know it can be kind of difficult to run through, especially during tax season. So just if you have a client and you think, hey, is this a theft loss that is deductible, or is this a theft loss that we could do for dust liability? You can send me an email. We can talk it through. I am really interested in this topic specifically, which is why I worked it in here. So I would love to talk about it. Okay, so one more thing that I want to talk about, or second to last thing, really, especially since we are nearing the 3/15 deadline, is penalty abatement for certain partnerships. In my tax compliance practice, I saw very often where clients would come to me to do their personal income tax return, and it was after the 3/15 deadline, and they would drop on me that, oh, we started a business. Me and my husband both started an LLC, or me and my brother, my sister started an LLC. And oh, hey, that's a partnership. And we've already blown the deadline. So it's late and you're going to be penalized. But under RevProc 8435, certain partnerships that meet certain criteria can apply for what is essentially an automatic abatement of the failure to file penalty. So what the RevProc says is that reasonable cause is assumed or presumed if the partnership can show that they meet certain qualifications, like that the partnership has no more than 10 partners, that each partner during the tax year was a natural person, each partner's proportionate share of any partnership item is the same as their proportionate share of any other partnership item, so essentially no special allocations, that the partnership did not elect to be subject to the rules for consolidated audit proceedings, and most importantly, that all partners reported their distributive share of partnership items on their timely filed tax returns. And that includes extensions. So even if a client comes to you in June or July or October and they surprise did a partnership, then as long as they report the income and expenses on their timely filed returns, then the partnership can qualify under RevProc 8435. So once the partnership files the return, then they get a notice 162B saying that the IRS has charged a penalty for late filing, and then the taxpayer responds to that notice with a statement signed under the penalty of perjury that they satisfy or that they qualify to the penalty evaded under RevProc 8435. All right, almost out of time. So last thing I want to talk about is payment extensions. This is something that clients ask about constantly, and generally the answer is no, you can't extend the amount of time you have to pay your balance to. But there is a small exception here under Section 6161. A taxpayer can request an extension of time up to 6 months to pay the tax due shown on a return. In the case of a deficiency determination, like an audit or an AUR, they can request up to 18 months. Now, this extension is not available if the deficiency was due to negligence, intentional disregard of the rules or regulations, or fraud. And this is applicable to income, gift, and certain excise taxes. Estates get much longer. They get up to 12 months to pay the tax due shown on a return, or up to 4 years to pay the tax in deficiency determinations. Now, this is an application. It may or may not be granted. It's not automatic. And it will only be granted where payment of the tax in full by the deadline would create an undue hardship on the taxpayer. Now, this cannot be a general statement of hardship. It has to be incredibly specific. Under the regs, an undue hardship is more than just an inconvenience. It has to be that the taxpayer would incur a substantial financial loss if they had to pay the tax in full by the due date. For an example, if they had to sell a property at a sacrifice price in order to pay the tax, then it would cause a substantial financial loss to them. Now, if there is a market for whatever that property is, and the sale of the property at the current market price would still result in a financial loss, that's not necessarily considered an undue hardship, even if the current market price is much lower than it should be. That's not per se an undue hardship. So you have to be very specific when you are requesting these extensions. The taxpayer must be able to pay the tax in full by the extended due date. Like, this is an extension, but you still have to comply. You still have to pay the tax in full. Interest continues to accrue regardless of the extension, but the failure to pay penalty is not asserted so long as the taxpayer pays the tax in full by the extended due date. So the fact that they're essentially just saving on the failure to pay penalty. So this is best in situations where the tax at issue is pretty large. For much smaller tax liabilities, I probably wouldn't seek an extension because it's just going to cost too much money and time that they would be saving on these failure to pay penalties. It really should just be used for larger things. If the taxpayer fails to pay within the terms of the extension, then the failure to pay penalties are then imposed. Now, paying within the terms of the extension means paying by that extended due date. They can't just wait to get a bill in the mail from the IRS. They need to proactively make that payment. So you use Form 1127 to request the extension, and it needs to include a detailed narrative, including a statement of the taxpayer's assets and liabilities, the book value and market value of their properties, and if they have securities, whether those securities are listed or unlisted, and then an itemized list of their income and expenses for the past 3 months. And look at publication 4235 to find the mailing address for this form, because there is a different unique mailing address for each state, and the address that you send it to is based on the taxpayer's state of residence. All right, that's all I got. I feel like I barely even took a breath that entire time. So we have like 1 minute for any Q&A, or you can also email me anytime at heather.posey@askfrost.com, or call me, and I'm happy to talk through any questions that you might have in relation to the information that we covered today.
All right, thank you, Heather. So it looks like we just had 2 questions. The first
Okay.
one, where would you find the established time frame for an action to be resolved?
This is difficult. It's normally in the IRM, but it would be in the IRM for that certain action. So it's very vague. It's not like there's a IRS website that has a really quick reference for, oh, I'm trying to request penalty abatement, or I'm trying to do an offer in compromise, and this is the established time frame. It kind of depends on what action you're trying to take. It would likely be within the IRM for that.
Right, and then the next question for the Maryland hardship, is there a definition of low income for a guideline?
Yes. So they look at the federal poverty line, and then if you are at or below 200% of the federal poverty line, then that is what they consider to be low income for Maryland hardship purposes.
Fantastic, thank you. And then we had one more question about slides. I did put those in the chat, but if you did not get them, we will go ahead and put them in an email follow-up. So you will get those if you did not download them from the chat. And I think that those are all our questions. Just checking. Okay, yep, looks like that is all we have. So thank you, Heather, for talking with us today, and thank you everyone for attending. As a gentle reminder, we just want to make sure that you complete the webinars and evaluations with that pop up at the end of the Zoom, because your feedback is crucial in helping us improve and provide you with better experiences in the future. So thank you all for joining us today, and we appreciate your time and participation. Have a great day.
Thank you.